We employ a risk-based approach to portfolio management. That means we aim to maximise portfolio returns for our clients within a given level of risk. Visually, you can think of that as smoothing the portfolio return outcome for our clients. So here you can see the green line is the Australian Shares Index. It's a much bumpier journey for clients, whereas the blue line is the Atrium Risk Targeted Growth Portfolio, and it's a much smoother outcome for clients. Alternatives are an essential component of achieving those outcomes for a client. But what does that really mean? In a nutshell, it means that alternatives provide diversification in our multi-asset portfolios. You may already be familiar with the way we separate the drivers of returns in our portfolios into growth drivers, preservers, and diversifiers. You can think of growth drivers as equities. Most of the clients will probably already have a pretty healthy exposure to equities. But what we're really looking for is many different types of return streams in the portfolios. And they are the diversifiers, and alternatives are diversifiers, which means the returns are unrelated to equity markets and what's happening in bond markets. A core skill of the investment team is to be able to identify managers that are able to generate consistent returns through the cycle, unrelated to what's happening in equity markets and in bond markets. During the GFC, the portfolios performed very well, thanks in large part to their allocation to alternative investments. In detail, it was the systematic trend-following managers that provided very strong positive returns in the face of steep declines in global equity markets. But let me make it clear, the alternatives are designed to provide positive returns through the cycle and not there just to offset declining equity markets. Implementation of many alternative investment strategies is actually pretty simple. Buying and selling securities, just like our equity portfolio managers do in other parts of the portfolio. Trend-following managers scour global financial markets looking for prices that are trending up or down. In simple terms, the system identifies when the price is rising and will buy, and when the price is falling and it will sell. It doesn't really matter what the underlying instrument is. It could be soybeans, it could be coffee, it could be the price of sugar, it could be the Great British Pound. All they are looking for is when the price is trending in one direction or the other. Most importantly, it doesn't matter if equity markets are going up or down. As long as there are prices trending in one direction or the other, these managers can be profitable. During the GFC, many investors had a poor experience with alternative investments. They got stuck in illiquid alternatives. I'd like to make it clear that here, we're focused on liquid alternatives. The trend-following managers I described earlier are trading some of the most liquid financial contracts in the world. In fact, far more liquid than the term deposits that might be in many of your portfolios. Alternative investments are included in our portfolios to reduce risk. Our alternative investments are diversified. You can see we have 12 managers spread across 4 different sectors of the alternative investments universe. The trend followers fit in the systematic global macro bucket. However, we also have multiple managers buying and selling equities around the world in the equity market neutral bucket. By adopting this approach, we are diversifying our return streams, and in doing this, actually reducing the risk of the multi-asset portfolios. You can see here that since 2011, alternatives have contributed strongly with 1/4 of the portfolio's total returns. They have proven to be a critical part of achieving our risk-based objectives in constructing multi-asset portfolios. They have provided diversification, but most importantly also provided strong positive contribution to returns.